This course will introduce you into the world of candlestick patterns and show you everything you need to know about it. It will take you right from the beginner level all the way up to the advanced level where you can actually recognize, trade, and profit from using candlestick patterns. So let's jump right into it. Candlesticks originated from Japan and are on record as being the oldest type of charts used for price prediction. They date back to the 1700s when they were used for predicting rice prices. During this era in Japan, a man called Munehisa Hama became a legendary rice trader and gained a huge fortune from using candlestick analysis. He is said to have executed over 100 consecutive winning trades. Now that's phenomenal, and that tells me something straight away about candlesticks. Candlesticks was introduced to the West many years ago by Steve Neeson and has ever since been used in Europe and United States successfully by many big financial institutions. Candlesticks give a visual representation of where price started and ended, the highest point of price movement and the lowest point of price movement within a certain time frame. For example, in a 1-day time frame, a 4-hour time frame, a 1-hour time frame, a 15-minute time frame, a 5-minute time frame, and even a 1-minute time frame. Each candlestick provides an easy to decipher picture of price action. Immediately, a trader can see and compare the relationship between the open and the close, as well as the high and the low of prices. So let's take a closer look at the anatomy of a candlestick. The first thing that jumps right to the eyes from this picture is that it's green. And what that means is that price closed higher than it opened. I'll explain. Now let's imagine that this is a 1-day candlestick. The open indicates the price which trading started for that particular trading day. And the close indicates the price which trading ended for that particular trading day. A green candle indicates that price moved up and ended higher than it started for that particular time frame. So in this example, it's a 1-day time frame, but the same rules apply if it were a 1-hour time frame. So a 1-hour example is price starting at 1565 at 4 p.m. That will be the opening price. At the end of 1 hour, which is 5 p.m., price ended or closed higher at 1670, hence a green candle. If it were a red candle, it would mean that price started higher, moved downwards, and ended lower than the starting point. So for a 1-hour time frame, let's say price opened at 1390 at 6 p.m. At the end of 1 hour, which is 7 p.m., price moved downwards and closed at 1280 at 7 p.m., hence a red candle. So in summary, when price moves up, the candle will be green, and when it moves down, it will be red. Now you may be wondering what these vertical lines are on top and under the candlesticks. They are called shadows or wicks. A shadow on top indicates the highest point price reached before it closed, and the shadow at the bottom indicates the lowest point price reached before it closed. For example, using the same 1-hour green candlestick opening price of 1565 that we used earlier, and the same opening time of 4 p.m., if 30 minutes later at 4:30, price rises to the highest point of 1704, then moves down and closes at 1670, which is still higher than the opening price of 1565 but lower than the highest point price rose to, then the highest point will be shown by a wick on top of the candlestick. Similarly, using the previous 1-hour red candlestick opening price of 1390 and the same opening time of 6 p.m., if 20 minutes later or any time before 7 p.m., price drops to the lowest point of 1190, then it moves back up and closes at 1280, which is still lower than the opening price of 1390, but higher than the lowest point price dropped to. Then the lowest point will be shown by a wick or a shadow at the bottom of that candlestick. Different candlestick shapes and patterns indicate different meanings. Some tell us that price is pausing after a move in one direction. Some tell us that price is about to reverse to the opposite direction of a move. Some tell us that price is continuing with its initial move. Mastering these patterns is very essential in deciding when to get into a trade, when to get out of a trade, and when to sit on both hands and wait. One candlestick will move up and down and keep changing its shape. You have to wait for the end of its time frame and the candlestick to be formed completely before deciding what pattern it is. Hammer and shooting star patterns, popularly known as pin bars. A pin bar is a 1-bar formation. The pin bar is a candlestick price bar which has rejected higher or lower prices. Price will open and move in one direction and then reverse during the time frame to close near or past the open. The tail or wick should be at least twice the length of the body, and the body should be at the upper or lower part of the whole bar. This formation is a good indication that price has ended its previous move and is about to reverse to the opposite direction. The longer the shadow or wick and the smaller the body, the stronger the indication of the price reversal. Color of the formation is not really relevant, although a green hammer bar may give a slightly stronger indication of a bullish reversal, and a red shooting star may also give a slightly stronger indication of a bearish reversal. It's the shape prerequisite that is of utmost importance. A hammer is relevant when spotted at the bottom of a downtrend, signifying a bullish reversal. Again, color of bar is not relevant. A shooting star is relevant when spotted at the top of an uptrend, signifying a bearish reversal. Again, color of bar is not relevant. A hanging man is a bearish candlestick pattern that forms at the end of an uptrend. This formation does not mean that the bulls have definitely lost control, but it may be an early sign that the momentum is decreasing and the direction of the asset may be getting ready to change. The reliability of this signal is drastically improved when price shows signs of decreasing on the next candlestick. The bearish engulfing pattern. This is a 2-bar formation. This is relevant at the end of an uptrend, signifying a bearish reversal. The red bar's body will totally engulf its preceding bar, that is, it will be higher and lower than one or more preceding bars. The more bar it engulfs, the stronger the indication that price will reverse downwards. The bullish engulfing pattern. This is a two-bar formation. This is relevant at the end of a downtrend, signifying a bullish reversal. The green bar's body will totally engulf its preceding bar, that is, will be higher and lower than one or more preceding bars. The more bar it engulfs, the stronger the indication that price will reverse upwards. The Doji Pattern. A Doji candlestick looks like a cross or a plus sign. Dojis form when price opens and closes at the same level. It represents indecision in the market, a supply-demand equilibrium where neither the bulls nor the bears are winning. When dojis appear at the top of an uptrend, it signifies that the trend has run out of steam. In other words, the buyers are losing power and the sellers are gradually coming in, but not totally in control, and vice versa in a downtrend. This may cause the market to move sideways due to the indecision. The Dragonfly Doji. The bullish Dragonfly Doji pattern is a rare and single candlestick pattern that occurs at the bottom of a downtrend. It is very similar to the bullish hammer pattern, except on the Dragonfly Doji, the opening and the closing prices are at the same level. The open and the close will also be at the high of the candlestick. The bullish Dragonfly Doji is more reliable than a bullish hammer, and it tends to be a stronger bullish signal. The Gravestone Doji. The Gravestone Doji is created when the open, low, and close are the same. The most important part of Gravestone Doji is the long upper shadow. It gives a strong signal when it appears after a long bullish candlestick at the top of an uptrend. It indicates that although buyers were confidently trying to push the price up, eventually sellers gained enough strength to return the price to its open position. A trader should consider taking profits and exiting if trading a long position, or place a tight stop below the close price. What is an inside bar? An inside bar is a candlestick that is completely within the range of the preceding bar, or a candlestick that has a higher low and a lower high than the bar immediately before it. It indicates time of indecision or consolidation.